pleased to welcome to this fireside chat Andrew Essey, the Chief Investment Officer of Centuria Capital Group. Welcome, Andrew. Can you please give us a bit of an overview of Centuria?
Thanks, Kwok. Thanks, Ben. Great to be here. Much appreciated. So, Centuria Capital, we've been around for nearly 30 years. We are an ASX Top 200 business with around 21 billion of funds under management, spanning across both unlisted and listed capital. We invest in sectors such as industrial, office, retail, and all their alternatives such as healthcare, agriculture, real estate credit, and now most recently data centers. So the unlisted side of our business is around 2/3 of our total AUM, which really comprises wholesale, retail investors as well as institutional. And the other third is the listed side, with really the main REITs being our industrial REIT, CIP, our office REIT, COF, and a REIT within New Zealand as well.
We all know there's been a few challenges in the market over the past few years. We sense that there's growing momentum. Of course, it's not even everywhere all at once, but we sense a much brighter outlook, and certainly the best we've had in a number of years, with a return to price growth and improving liquidity. What's your sense of things, Andrew, as we enter the new year?
Absolutely agree with that. There's no question that the last 2 or 3 years now have been a bit choppy or difficult, but I think the evidence is really shown by the transactional volumes that have picked up really across the board in most sectors. You're seeing not only buyer depth on-market processes, but transactions that are occurring off-market, where it's not just the 1 or 2 groups that you might expect to be buying that asset, but another crop of groups that are really stepping up and being very, very active in this market. I think most notably as well, it isn't one type of buyer in terms of capital support. There are local managers with domestic capital, there are local managers with offshore capital, everything in between. And we also saw a recent major office transaction undertaken by a REIT. So I think that all these are telltales that the pricing has really adjusted from a valuation standpoint that's more in line with transactional appetite. And where you see the buyer volume or the transactional volume increasing, I think the proof is in the pudding again that values have gotten to a point where those that are looking for liquidity can exit at a reasonably strong price. And I think that this is only really starting now. It really feels like the momentum is turning from where it was over the last 12, 24 months. Are we in sort of 2019-20 volumes? No, but I think that where we are heading feels much more of a buoyant transactional market looking forward.
And Andrew, your business is very good at finding opportunities in subdued markets. Indeed, over the last 12 to 24 months, you guys have been actively trading. You're very good at, again, finding opportunity in dislocated markets. Is there an example of a transaction that you might give us that you've undertaken in the last 6 to 12 months that might support some of your views about where the appetite for capital is at the moment?
Absolutely. So, Kwok, you might know we executed the Port Adelaide Distribution Center acquisition. We only settled that at the end of October. We liked the opportunity because it had the right scale that we can really attract some, significant investor checks for that type of investment. But really, it was right down the fairway for what we believe in, and that is a significantly under-rented asset that's at a circa 70% discount to replacement value if you were to build that next door, which you can't because the land's so constrained, and a market that has amongst the lowest vacancy rates in the world. So when you sort of take those 3 key elements and you put that into an investment thesis, it's sort of a no-brainer for us. Now, is Adelaide the #1 investment destination for most groups? Certainly South Australians it is, but I think from a global standpoint, no. I think East Coast is #1, and then after you go through Sydney, Brisbane, and now Melbourne, that's when capital really starts to focus in on markets like Adelaide and Perth. But we've got big teams in these markets, we have big exposure to these markets, and I think we've really recognized that we can make really good money, getting exposure to an asset like this that has all these key characteristics. And I think really interestingly, Kwok, on this one, not only was it really, really well subscribed by our domestic wholesale and retail investors, which was our expectation. We closed the raise early and it was basically double oversubscribed by those groups. In addition to that, we had significant interest from offshore institutional groups, major groups. So we ended up bringing in a Japanese group to the fund. We also brought in a North American group to the fund. So it's a combination of institutional and wholesale capital, where traditionally the types of groups that invested into this fund, we expect them to want control. We expect them to want to be the sole or one of the, a very small group of investors into this fund, whereas this fund has over 600 investors, 2 of which are these major global institutions.
When we look ahead to the next cycle, it seems reasonable to think that a higher proportion of return is going to have to come from income growth. And, in that light, I think the current debate on economic rents is interesting. We've done some analysis showing that in most cases, it's difficult to get new developments to stack up. That's particularly the case in offices. It's also impacting other sectors, and arguably it's been a feature of the retail market for some time. I mean, how is that impacting your view when you're looking ahead to income growth potential on the assets you're acquiring?
No question, the economic rent story is very, very real. When you're looking at investments, you have to consider what new supply is going to be, doing to your investment, particularly over your hold period. So where we stand today, there's no question that development feasibilities are under pressure, right? You had this sort of trifecta of cap rates moving out, interest costs going up, costs of construction going up significantly. And what does that lead to? That leads to an economic rent that is significantly higher to make a development stack up. So we are doing some developments, no question about it. And the one lever you have is that rent. So if you can hit that rent, that development stacks up. And whilst we are seeing less supply in the market, there are still buildings being built. Don't kid yourself, across all sectors. So we believe that the opportunity is now to invest in stabilized assets or existing assets and capture some of this significant rental uplift or reversion that is really being commanded by these new developments. And the tenants, in most cases, can pay or can sustain these rents. It isn't necessarily whether they can pay the rents. We believe it's more, will they pay the rents? And the reality is, if you look across, many parts of the sectors, and I'll give you a couple of examples, infill industrial in land-constrained locations. It is very, very hard to find a 5 or 10,000 square meter vacant facility that meets a lot of these tenants' needs in these locations that they must be in. So if you're able to put on supply in these markets, the economic rents are at new record levels, but these tenants are willing to pay this rent. There just simply isn't the land to be able to deliver this space. Another interesting sector is large format retail. So, there is almost no vacancy across the country in this sector. There is very, very minimal supply, and most of the tenants are growing or want to grow. So as these leases come off, you now have 1, 2, 3 tenants wanting the same space, and that gives landlords a bit more say in what the rents can be. So yes, you're coming off of a very well established base, but we've seen rent reversion in this space, to the tune of, 10+% in many portfolios. So again, I think back to your point, economic rents have to come up, or the economic rents for new developments is significantly higher, or they are significantly higher than where they have been in the past years. And I do believe that is now having an impact on what the overall market rents are for existing assets as well.
Our report also talks about leasing still being challenging in the markets. Are you finding that across your portfolio, across your industrial and office portfolio as well?
Good question. I think the world had a massive shock in this sort of tariff war that kicked on in March, I believe it was, or I think it sort of, it started in April, sort of ended in May quasi, but it's still going on. But are we having trouble in leasing? Our occupancy across the portfolio is very, very high, in excess of 90% in every sector. In some sectors, it's nearly 100%, like LFR, where we have no vacancy, and with a very large portfolio. So I think that decision-making timeframes have extended a little bit, and that is partially due to some uncertainty pertaining to the tariffs that were introduced. But we largely see that washing through. We largely see tenants now deciding if they don't make a decision quickly, they will miss out on space. And I think when you look at particularly the top end of town, and that doesn't necessarily mean Sydney CBD core. Top end of town can mean many things. It can mean, the best of its class within its micro market. It can be a metropolitan office building, but is it the best building or top 2 buildings in its class of assets? That's best in class. So therefore, I think tenants recognize that the space within the best-in-class tenancies within the market is not high vacancy or does not have high vacancy in any particular market. So I think as you work through that, tenants, whilst I think decision-making has been a bit protracted, we are now seeing for that upper echelon of space in the respective markets, decision-making is much quicker, and we're seeing that space leasing up.
It's a good point that you make, because part of our report talks about the importance of asset selection. And you talked about tenants picking the best-in-class assets in the market, be it retail or office or industrial. How has your team been able to look at the acquisitions that you're looking, or repositioning of your portfolio from a divestment strategy point of view, in relation to making sure that your portfolio has been recycled to ensure that you have those best-in-class assets to capitalise on the best rental returns across your portfolio?
Good question, Kwok. I think for us, we started as a single asset syndication business. So whenever we buy a building, whether it's for a single asset fund or for our $4 billion industrial REIT, we're very, very critical of that individual asset and whether it can stand up on its own 2 feet. And we are obsessed with the lettability of these assets. So we might look at a building with an industrial asset or a retail tenancy, might have a 5-year lease in place. We always ask ourselves, if it was vacant today, how much could we lease it for and how quickly can we lease it? So I think to answer your question, Kwok, we have a pretty diverse business now that has a lot of closed-end funds. So we're always trading assets out of the market. We always have funds that are, right at their end of investment period and looking for liquidity. So I think provided we continue, and we will, to invest in assets that we believe in from a leasing fundamental standpoint, we should never really have an asset that's that hard to divest. Now, I think most investors ultimately, some buy whale, some buy cash flow, but most real estate investors want to buy a building that they are confident they can lease, in good times or in harder times.
So really talking about going back to the fundamentals of real estate. No longer can we ride the cap rate compression curve. It really is, as you mentioned, we've walked through a lot of cycles, and location is key. Finding good assets close to transport, food and beverage amenity. If it's an office asset or indeed any other asset, then health and wellness is a key consideration for tenant retention nowadays. So it really is a little bit going back to the fundamentals of the Centuria business, as you talked about, from when it started about 25 or 30 years ago.
Yeah, absolutely. Look, we've never been a capital allocator per se. We've never sort of ridden the wave of investing in a sector because it's the hot sector, or becoming a hot sector and not divesting the entire portfolio when it's ripe. We do look at cycles. There's no question about that. We do consider when to buy, when to sell from a cap rate or from an investment standpoint, but it's not really going back to the fundamentals for us. It's just staying within the fundamentals that we've always invested in. That's not going to change. Hasn't changed over the years, and there's no plan in looking at investments any differently moving forward. But I think just touching on your point of reliance upon cap rate compression for returns. Now, when we look at investment opportunities, we don't have a reliance upon cap rate compression on the returns. But I think if you're investing in this market today and you're seeing buyer competition increase across the board, particularly in sectors that have been softer over the last 2 or 3 years, like office, as you see the capital demand increasing, it would be hard to ignore the fact that there's still a counter-cyclical investment opportunity at this point in the cycle. So whilst we are significantly relying on the returns based on operational income producing measures, we do believe that you can take a counter-cyclical lens on investing today to believe that the market is already moving in a particular direction. So we believe that there is money to be made on cap rate compression in this market.
Over the past few years, beds and sheds has been a pretty consistent refrain, and by that I think we can all take to mean that investors have perceived, and it's probably not only in Australia but globally, that that's where the growth would be, both in terms of the growth of growth in stock and also potential capital growth. We sense, though, that after a large relative repricing, where we've seen office and retail hit a bit harder in the downturn, that it might be time for a new narrative. That not to say that beds and sheds will not be in favour, but it's no longer quite as clear that they will outperform. What do you think?
I think there's no question that there's a bit of a rebalancing of investor demand right now. So beds and sheds are still hot. I think most groups, in particular offshore groups, I think beds and sheds are pretty much their top one or two, and those can be rotated between the two. But most of these groups that are investing in and looking at beds and sheds are also adding retail to this narrative, if those aren't already there. So, and even more so, we're finding that more and more groups are expanding their investment directives to not only plan to invest in office, retail, or maybe some alternative sectors, but they're now deploying in these sectors.
Thank you. That's great.
Thanks very much.
Always good to see you, Andrew.
Good to see you.